We have seen increasing concern and uncertainty around regulatory risks, specifically as it is related to China-based companies listed here in the U.S. and just sort of what the profile for the Chinese economy looks like broadly going forward. Joining us now to talk about all of this is Tiffany Hsiao, Managing Director and Portfolio Manager at Artisan Partners. Tiffany, thanks so much for jumping on. I'd love to just start with, in your broadest outline, how you guys are thinking about regulatory concerns in China for companies that are doing business in China and how maybe that profile has changed in the last handful of months.
Yeah, I think what we're seeing in China is really a catch-up to global regulatory standards in terms of, particularly when it comes to data privacy and antitrust regulation. And a lot of these policies have been openly discussed in consultation papers and discussion with the industry ecosystem and peers. So I think a lot of the regulatory surprises to the market really aren't that much of a surprise for the more astute students of Chinese regulatory frameworks.
And Tiffany, you write about this a little bit in a recent paper, Regulating Risks in China, Sorting Signal from Noise. And you talk about how this is sort of a maturation of China's version of capitalism, which of course is intertwined with communism. It does seem abrupt, right, for external observers who are not close observers like yourself. What has sort of been the drumbeat to this? And then what follows it, right? Does this keep going? Do we continue to see more of these types of regulations put into place?
Yeah, so China is a planned economy. We do have to keep that in mind when you're investing in China. If you look at the past 20-year history of investing in China, China started off with developing its financial system, its property industry, and then it moved on into building the digital infrastructure with companies that are now household names even to the U.S. investor. But the next stage of growth, where China really needs to deepen its self-sufficiency and expertise, really are in areas such as semiconductor and software and healthcare. In these three particular areas, China is still importing 70 to 80% of its own necessities. And with a lot of talented people in China looking towards making, perhaps in the government's mind, shorter term gains in sectors such as e-commerce, online gaming, there's a mismatch in the talent, right? China needs people to work on the next generation of oncology drugs, the next generation of semiconductors that could rival U.S. companies, but that is not being done because there are so many other opportunities in the economy, which the government thinks is already well developed and actually should be moderated because of some personal data privacy issues and also some antitrust behavior.
Tiffany, I'll just single out Alibaba here, and the stock is down about 22% over the past 3 months, just given a lot of these concerns, certainly Didi, others under pressure. How should a U.S. investor approach some of these stocks? What is the buy signal here?
Yeah, it's difficult to say, but I think that after this round of regulation, the rules will be much more clear, and investors will have to make that decision. Do I want to continue to invest in an industry that is now highly regulated and growing at half the growth rate that it used to? Or do I want to invest in these emerging industries which have the full government support in terms of regulatory support and are growing at rates 2-3x of players like Alibaba? So I think in China, there's an abundance of growth opportunities. And I would encourage people to really look beyond your traditional comfort zone. There are some really world-class companies in the making. You just have to know where to look and to look deeper.
So can you give us a little hint of what those might be, Tiffany? Is it the industries that you were talking about before in terms of healthcare and semiconductors, or should we be looking elsewhere?
I'll just give you some really staggering statistics. Let's just take healthcare as a singular example. China obviously is going through a demographic problem. There's an aging society, and it comes with the age-related illnesses. For example, joint replacement. In China, less than 0.1% of joint replacements are done by robots. That is less than 1/10 of here in the United States. And based on the planning by the government, they want to make sure that over the next 5 years, that improvement is 50-fold. There's actually a critical reason behind that, why robots are so critical in China's surgical landscape. That's because, again, a lot of the top talents in the industry went into perhaps e-commerce companies. In China, less than 5% of surgeries are done by surgeons under the age of 45. There's an aging problem. It's surgeon population. So you do need next generation innovation, for example, surgical robots, to really step in and help fill the gap.
This is really interesting stuff, Tiffany. I love it. To turn away from this for just a second, I would be remiss if I didn't ask you about what's going on with Chinese economic growth, and in particular, the curbs that the Delta variant spread also now seem to be putting on the economy there because of the government sort of shutting certain things down. How much of a concern is that for you?
That is a short-term concern because China is taking a zero COVID policy. But I think over the long run, it doesn't impair China's key growth pillars, which are that it has really a large amount of human capital talent. It has now a very patient capital pool. Despite the volatility you see in the market, the private equity market is still very buoyant. And then finally, the government is supportive. Regulatory support is there for industries where the government wants to direct innovative capital and really to foster that growth and innovation.
All right, we'll leave it there. Tiffany Hsiao, Managing Director and Portfolio Manager at Artisan Partners. Tiffany, really appreciate you taking the time to jump on this morning.
E-scooter player Bird says sales are on the rise as people become more mobile around town during the pandemic. Bird's momentum right now has it eyeing profitability by 2023. Joining us for more on Bird is Bird founder and CEO Travis VanderZanden. Travis, good to see you again this morning. Take us through what you're seeing right now on the ground in your top 10 markets.
Yeah, so we're seeing a pretty strong bounce back from last year. As cities really open up and the vaccination rate rolls out, we're seeing a lot of people obviously want to get outside of their house. They want to rediscover their cities, and Bird is a great way to do that, especially in a naturally social distance way. And so if you look at just to kind of throw out some numbers, I mean, we just reported on our Q2 earnings, and we did $60 million in revenue in Q2, which represented 477% increase year over year. So we are seeing a strong bounce back, and people really wanted to get out of their their houses and rediscover their cities. The thing we're most important about it, excited about in the Q2 earnings though, is just the fact that we beat the expectations by so much. So on the revenue side, we beat our SPAC pipe forecast, which we just put out earlier in the year. We already beat that by 36%, and ride profit margin of 49%, which outperformed. And then even adjusted EBITDA of negative 12 million was 48% above the SPAC and pipe expectations. And so that's something we're super proud of as a company, and we think sets us up well for the future.
We have seen a tick down in some areas of mobility, lots of concern around the COVID variant. Have you seen that in your business?
We really haven't. We're watching the Delta variant closely, just like everybody else. And I know, transportation is obviously impacted heavily. I think in our case, Bird is a naturally social distance way to get around cities. And so we haven't seen a big impact from the Delta variant. I think as long as cities don't shut down again like they did last year, and obviously it made sense last year, but this year it doesn't seem like, cities are going to shut back down again. And I think, assuming they don't lock down, I think, Bird is still a great way to get around your city. If you don't want to share a car with maybe a rideshare driver or share, a public transit with other passengers, you can take an electric scooter or our new electric e-bike, which we announced yesterday. Also a great way to get around your cities.
Hey, Travis, it's Julie here. Whether it's the e-bike or the scooters, there have definitely been some sort of regulatory hiccups, right, in various cities around the country, around the world, when it comes to your company competitors as well. What's the sort of current status of those relationships?
Yeah, we spent a lot of time working with cities. They really are our number one customer, and Bird is in over 300 cities now across the world, and so I think it's cities really have embraced micro mobility and micro electric vehicles. in their cities. Every city we talk to around the world wants less traffic, less carbon emissions, less parking problems. And so, microelectric vehicles are a great way to solve transportation problems immediately. I like to say we don't need, autonomous cars. We don't need tunnels. We don't need flying cars. What we need is more bike lanes and more microelectric vehicles in cities. And we're really, cities have really embraced our mission, and it's been great to work with them.
Travis, really locking in, on your outlook. So for 2023, you see adjusted operating profits, about 144 million. This year, looking for a $96 million loss. What has to happen for you ultimately to reach that profitability level?
Well, like I said, we just need to keep executing. We need to deploy more vehicles. We have our new fleet manager model, which has been performing very well. But look, the proof is in the pudding. And looking at our first quarter results on adjusted EBITDA, we came in at negative 11.5 million, which was 48% above the forecast that you just mentioned. So, we are trending, better than the forecast we just put out over a short period of time. And that's something we're very proud of because, I know SPACs have gotten a little bit of a bad name over the last 6 months, but we think what's most important is how are those SPACs performing relative to their forecasts. And I know some of them might have gotten a little aggressive on forecasting. At Bird, we try to stay as conservative as possible. And that really shows in our Q2 numbers and the big outperformance we had.
Well, and, Travis, to that point, we were talking about a different SPAC, completely different industry, but, a transaction that failed to be consummated earlier in the program. I'm curious, leading the company through this period, does it feel like you're already public in terms of the scrutiny that's come on the sector? And certainly, had you guys at Bird wanting to focus up and make sure that, you're delivering on what you'd outlined back in May?
Yeah, for us, we're excited to get the numbers out there. We think there's a lot of misconceptions on the category, and I think continuing to show progress quarter over quarter and releasing those audited financials is actually a good and healthy thing for the business and really the whole industry. But like I said, the most important thing is really beating that forecast and continuing to execute as a company, and that's what we fully intend to do.
All right, we'll leave it there. Bird founder and CEO Travis van der Zanden, and good to see you, and we'll talk to you soon.
Hey, thanks for having me.
Factory output in Asia is as high as it's ever been, but they're still behind in orders. Ship space is not enough, even with 99.5% of all vessels deployed worldwide and in our Trans-Pacific arena. We've got 32 ships at anchor today awaiting berthing space, yet our productivity is higher than ever. It's kind of like squeezing 10 lanes of freeway traffic into 5.
That is Port of LA Executive Director Gene Sirocco speaking to us earlier this week about the impact the port shutdowns in China have had on the U.S.'s largest port. The container port at Ningbo Zhoushan remains partially closed now for more than a week since an employee tested positive for COVID, and the prolonged closure is threatening to disrupt supply chains around the world, potentially into the holiday season. For more on that, let's bring in John Cartsonas. He is Breakwave Advisors founder and managing partner, joining us from Greece today. John, it's great to talk to you. I know you've been you've been in touch with those on the ground over in China as well, getting a better sense of how significant these disruptions are likely to be. What's the very latest you're hearing?
Well, I think the situation is getting worse by the day. But again, it all depends on how the virus will progress in China. If you step back a little bit, I mean, this has been building over at least a year now, because obviously the first wave of the pandemic led to a significant slowdown in the economy and a slowdown in trade. And once the economies came back at the same time, you had basically a massive move of products and raw materials from point A to point B. And when you stop such a big logistical chain and then you restart it with demand increasing so much, is what you get, congestion. And it's not only obviously on the container side. You see the same thing on the dry bulk side. As we speak, about 15% of the dry bulk fleet is basically waiting and congested outside ports. So it's both the container ships, which obviously affect the consumer spending, and the dry bulk. And I think that will be with us for a while, because obviously shipping and the massive amount of cargo that they move takes a lot of time to clear and return to some kind of a normal situation.
So when you say it's going to be with us for some time, what kind of backlog are we talking about? And what specific goods do you think are most likely to be affected?
So I think as you look now at the peak shipping season ahead of obviously the holidays, if that lasts for a few more weeks, you will have an impact obviously on the peak shipping season. And here I'm talking about mainly consumer goods. When you look at the bulk materials, commodities, again, it depends a lot of how the virus will progress in China. Obviously, over the last few weeks, there has been an easing in terms of the virus situation, at least on the port side, and hopefully that could potentially lead to some easing on the congestion. But again, as we know, the waves come and go all the time, and it's not only in one particular port like the Ningbo port or Shanghai. You have at least a dozen ports that this is happening. So this is causing basically freight rates to increase substantially, because if you have one ship and three cargoes, these three cargoes are competing for the one ship, and whoever pays the most is taking the ship. And that's what's happening today with freight rates. I mean, if you look at the Baltic Dry Index, which is a very well-known index for shipping, it hits an 11-year high, actually, every day now for the last few weeks. The same thing goes on the container side. So I think, pricing is very related to the supply and demand, and the supply, which is congestion, is very tight today.
Well, you say this is going to take a while to play out. We're already thinking about the holiday season here, and I've seen a few reports that are raising the hairs on the back of my neck here. I'm just wondering, how bad could it get? And I don't want to get into any fear mongering, but could there be some kind of meltdown if the situation worsens?
Well, I mean, I don't know what the meltdown is in terms of measuring, but in reality, it is, you're talking about tens of thousands of ships that are moving immense amount of cargo every day. Now, this machine was very well oiled until basically the COVID-19 crisis. And now it's a mess. I think that's the best you can describe it. It's very difficult for people to plan. It's very difficult for people to basically make plans for the next month, let alone 6 months down the road, because the waves come and go. So let's say another virus wave, in China or in certain ports happens, immediately you have the same issue. And it's not only about the crew on board, it's about the people who work on the docks, right? You have about the pilots. Mm-hmm. So China is putting a lot of measures in order to prevent that, and that's causing more and more delays. Can it spill into next year? I think it can, but for now, I think as we focus on the holiday season, things through, I think people should expect delays in deliveries. The people who actually buy goods, consumer goods, is the same thing.
And John, those disruptions you've pointed to have led to a lot of conversations, internal conversations with companies who are saying, well, where should we reposition our supply chains because of what we've learned over the last year or so? What are you hearing in terms of those conversations? And do you see the center shifting away from some of these major ports in China as a result of what we're seeing play out right now?
It's very difficult to see such a repositioning because the world has been, for decades now being, you have the producer region, which is basically Asia, mainly China, and the consumer area, which is the Western world. So, it's very difficult to see such a repositioning of shipping if you don't reposition the producer and consumer areas of the world. I think probably one thing that's happening is basically there is a lot of inventory rebuilding, which is very difficult as well because inventory storage, both for bulk commodities and for containers, is almost up full. So you cannot even buy in advance and store it when you need it. So it's both the inventory situation management and the, let's say, up-to-minute shipping management that the companies have to manage here. I'm hearing actually reports that actually all the grain inventory facilities in China are basically full. So or not all, I wouldn't say all, but a lot. So you have basically, ships waiting to offload cargoes. They cannot do that. That causing more strain into basically the port infrastructure, whether that's containers or bulk.
John Cartsonas, Breakwave Advisors founder and managing partner. Great insight, especially what's playing out over in China. I appreciate the time today.
All right, Elon Musk is saying it's time to build a fake human, a humanoid robot for, quote, doing boring, repetitive, and dangerous work. We have Carl Brauer here of iSeeCars.com. He is an executive analyst. So I hope we got some great B-roll for this because I want to see what's going on with Elon and this new humanoid robot, or has he not really begun yet?
Well, let's hope it's good video and nothing out of, say, a Will Smith movie in iRobot, right? I find it funny that one of the descriptions he's got of this robot, which apparently he's calling Optimus, it's 5'8", so it's not unusually large, and he specifically mentions that it's meant to be designed so that humans can overpower it or run away from it. So this actually kind of connects well with past statements we've heard Elon make, where he was concerned about, robots making robots and, kind of a Terminator future and stuff. So I find it, interesting how he's trying to execute this very advanced computing capabilities, which is smart because we know that's where the world's going and he wants to be a part of that. But he's trying to do it in a way that doesn't scare anyone, probably mostly himself. Should be interesting.
Yeah, I mean, if you look at the AI Day event, this isn't one that was necessarily geared towards investors, but Elon Musk did unveil, in addition to the humanoid robot, a new custom chip. What do you think some of the headlines coming out of the event yesterday tell you about Tesla's ambition beyond cars?
Well, he's shown that ambition where whether he's taken us to Mars or he's powering things through solar. He's very good at identifying trends that are coming, and if he feels there's a lot of certainly money to be made, but also I think world-changing influence that can be done through these areas, he'll jump in there. And we know again that advanced computers, artificial intelligence, they're necessary for his near-term goals like autonomous self-driving and the ability for the cars to learn and handle almost any situation. You really do need a lot of advanced computing power, but you also can do a lot of other things with advanced computing power. We think that everything from the power grid to medical care, obviously military operations, these things and more are going to be relying more and more on advanced computing. If he can come up with his own proprietary chips and his own processing power, and it proves as good or better than anyone else's, he'll be in a pretty powerful position for a lot of the future evolution we're going to see here.
Yeah, and you talk about advanced computing. It doesn't get any more advanced maybe than a human, but second runner up has got to be autopilot. And I am shifting gears a little bit. I want to talk about that investigation that was announced Monday by the National Highway Transportation and Safety Administration into, I believe, 11 crashes, some of those with first responder vehicles. This is going to be an issue that we're going to have to deal with over the years. And because there's going to be some spectacular blowups, it's going to get a lot of headlines here. I'm just wondering, do you think Musk has gone too far, too fast here with autopilot? And what are the fallout going to be from these investigations?
Well, certainly from certain aspects, you could, I think, describe that he's talked a little more the talk than he's been able to walk the walk. We were supposed to have 1 million robo-taxis by the end of 2020. He said that, not that long ago, and we didn't quite get there. So he's got a history of, somewhat over-promising and somewhat under-delivering, at least in the timing. But he is good at predicting where things are going and putting himself in a position to be there. We're in the learning curve, though, as you mentioned, for autonomous driving. We're deep in the steep part of the learning curve. And unfortunately, when you're doing that with vehicles that are on public roads, you're going to have accidents and potential fatalities. And I think the government is now investigating him because they're going to try to assess not only what's gone on in the past, but what future risk is being involved in this, and whether there needs to be a more stringent rule set or guidelines that companies like Tesla and any other company have to follow before they're putting out, moving vehicles of multi-ton vehicles that are not being driven by humans, or at least not being driven by humans as much as they should be.
Carl, on the EV space specifically, we have seen a number of the traditional players like a GM or a Ford accelerate their timelines for going 100% EV. And we've seen the quickness with which they've been able to adapt. And I wonder, when you think about the Tesla advantage, has your thought on that, your calculation around that shifted, or you think Tesla is still way ahead of the pack when we think about the transition to greener technology moving forward?
Yeah, this is a great question. I love this question because it exactly targets what I have been watching over the past 12 months, which is the idea that these companies, Tesla being the most well-known example, but there's others out there, Rivian and Lucid and a lot of these other companies that are working to create really capable electric cars, and this assumption that they're going to come in and start swooping market share from the traditionals. That was an easier story to buy and to visualize 12 months ago. The movement of the traditionals in the last 12 months, both the financial commitments that we've heard them make, but also the actual product development that we've seen them do, has made me think they're going to put up a much bigger fight. And I can't believe that the CEOs of these other companies aren't maybe having meetings going, this isn't going to be as easy as we thought, is it? The new F-150 Lightning is hugely impressive. It's more than just an F-150 with a battery pack. It's got a lot of innovative features that Ford came out with. Just 2 days ago, I saw the new Cadillac Lyriq that's going to go on sale in Q1 next year. And it looks really impressive on every level, from styling to mileage, range, and technology. And the interior looks great with this huge display that looks very attractive. So there's a lot more going on with the traditionals in the EV space than there was 12 months ago. And I think a lot more is coming a lot faster than these startups probably expected. And I think there's going to be a much bigger battle for that market share. And the traditionals are not going to give up that share easily. And it's going to be tough on the startups.
Yeah, I'm looking at the Wi-Fi Interactive here. Ford up 42% for the year. Volkswagen up 26%. Those two right here. GM 17%. Tesla down 4.2%. Now, we've seen a number of companies like Nikola, Lordstown Motors, pre-revenue companies that have just gotten absolutely demolished. I think this is what you're talking about here. Any of these smaller companies that you happen to like, maybe not pre-revenue, that you think have a chance in this space?
I think Rivian is still a pretty compelling startup. Everything from the employees that work there and the RJ Scaringe, I'm trying to remember his name, but the head of that company and the kind of people he's got working there and their histories, the vehicles that we've already seen, and really just as importantly, if not more so, the partnerships he's already made. He's got investments from Ford and Amazon. I mean, these are two huge players in the market out there. And if he starts to get orders in from someone like Amazon, and he starts to work collaboratively with someone like Ford, he'd have a lot of advantage over what he's already got done on his own. That's also very impressive.
Carl Brower, always good to talk to you. Executive analyst at iccars.com. Have a great weekend.
And as you saw, those reopening stocks, including the airlines, the hotels, the cruise lines, have been trying to bounce back after that sharp sell-off we saw earlier this week as the rise in COVID-19 cases due to the Delta variant start to put a damper on the travel industry, which was bouncing back quite nicely just about a month or so ago. But here's a proposition for you. What if during your next hotel stay, you had to pay for things like early or late checkout, or perhaps the pool or access to the gym, but in return, you would get a reduced room rate? Well, one of the largest U.S. hotel owners, MCR Hotels, is among those experimenting with this a la carte pricing. Joining me now is the chairman and CEO of MCR, Tyler Morris. Tyler, good to see you. Before we delve in, just want to let people understand the scope of the company. You've got more than 100 hotels in 33 states, including the TWA Hotel and the New Yorker. I'm curious how many of those hotels are trying out this a la carte pricing, and what are you hearing from your clientele?
So we're testing it out at our independent hotels. That is the non-branded hotels. So far, customer feedback has been great. They like the lower rates, and people who want early check-in and early check-out are okay paying for it. They're fairly modest numbers. And really, this is how the airline industry started when they started charging for bags. It took them about 5 to 7 years to lay in a lot of those ancillary fees. Customers were not very happy on day one, and then they kind of got used to it because it allows businesses, in our case, hotels, to charge lower room rates, which everybody's appreciative of. By unbundling the product, you segment the different demand characteristics because people don't want to pay for services that they're not getting.
Makes sense on paper, but give us a feel for what these fees are like. How much might you pay for an early check-in, or for the ability to use the pool, and how would that impact your room rate?
Yeah, so an early check-in might be $15 to $20. A late checkout might be $15 to $20. We have a free pool access in the mornings, but if you want to go at the high demand period, it could cost $25. It's not that dissimilar from charging and paying for Wi-Fi. If you want access to super, super fast Wi-Fi, you pay a bit of a premium for that. If you just want the slow boat in terms of Wi-Fi, that might be free or at a lower price. But by going to an a la carte menu, it allows people to customize their experience and get exactly the product that they want when they want it.
But I'm wondering if there's any concern here that you might be putting yourself at a disadvantage because you're sharing the market with some of the large hotel chains who are going to be slow to adopt something like this. I mean, even the new CEO of Marriott has gone on the record as saying, we're not running to try this a la carte pricing, and you're also competing with the Airbnbs and the Verbos of the world. So is there a concern that folks will just find other options elsewhere if they're not willing to pay for these extras?
Sure. I mean, I think consumers always have choice. They can always stay at different hotels. And that's why you got to have the nightly room rate be lower. And then maybe some of the add-on charges people don't want to have. Business travelers end up paying for the pool, whether they like it or not, even though they very rarely go swimming. They pay for the free breakfast, even though they may not eat the free breakfast. They may just grab a cup of coffee and hit the road. But consumers always have choice in the matter. And I think the more hotels that put forth the a la carte pricing plan, the more customers will get used to it. There's a lot of technology backbone necessary to even execute this model. But by unbundling the product, hotels historically have just keep throwing things in for free, more free stuff in order to compete with other hotels. We're saying, let's go the other direction, lower the room rate, and then charge people for what they want. And I think all the big brands will catch hold of this because it's better for hotel owners and it's better for guests. It's really the micro economy, I call it. When you buy a movie on Apple TV, you pay $3.99. You buy a song on iTunes, it costs 99 cents. These are small, modest dollars for a breakfast sandwich or a cup of coffee or a little Wi-Fi or a pool fee. These are not big dollars. And so customers' price sensitivity to those dollars is pretty low.
You touched on, I think, a key thing there, and that is technology, being able to have the right tech in place to offer sort of this a la carte pricing in a meaningful way that won't be disruptive to the customer. Do you have that kind of infrastructure in place? And do you think that technology is going to be an impediment to the industry overall adopting it?
It will slow the industry down. We do own the software necessary to execute this. Last year, we bought a property management system called Stay in Touch. And it is an unbelievable system, and it allows for you to charge in increments like this. It thinks of the world as 24 units of inventory per day, as opposed to 1 unit of inventory per day. So it breaks down the product into micro pricing, which is obviously where the world is going. You see it on the Uber app, you see it on the Apple TV app, you see it with what Disney Plus is doing. And instead of charging people these huge numbers, when you break it down into smaller incremental pieces, customers like it because they get what they want. But it does take a big technology backbone to execute this. The hotel business is very behind in a lot of its technology. So by acquiring this software system, which we did last year, and we're buying a couple of other software systems to bolt on to this, it allows hotels to be more flexible. And some hotels will have greater pricing power for the a la carte pricing than others will. So you have to go product by product, market by market. In New York City, there's a high demand for this, and it's relatively easier to execute. If you are in Dubuque, Iowa, it may not be as palatable from an a la carte pricing standpoint.
Right, I got you. Got to ask you though, before we let you go, what has demand been like at your hotels now that we're seeing the Delta variant, spread throughout the country? And you mentioned the business traveler earlier. I'm wondering if you're starting to see that depressed segment come back a little bit.
So demand has been very good. Our TWA hotel is performing very strong. So is the Highline Hotel, but we're running about 80% occupancy across our system of 20,000 rooms right now. What a lot of people don't see is that there are 156 million employed Americans. Only 20% of them work in a traditional office building. Most people are out there working every day, and you can't do your job via Zoom. If you're a plumber or a bus driver or a hotel housekeeper, you got to be on site to do the job. So 80% of the economy is running quite normally, but the media reports that people are working from home, et cetera. But that is a small component of the population. And our hotels have, generally speaking, been very full. We have seen a 10% decrease due to the Delta variant in the last 2 weeks or so. So we'll see how we do in the fall. But we are seeing some softness in forward bookings because of Delta. But my takeaway is that 90% of people are plowing through, traveling anyway, and frankly are tired of being on Zoom and want to get out of their basement.
Yeah, a lot of pent-up demand out there for sure. Tyler Moore, CEO of MCR Hotels. Thanks so much for being with us. The U.S. government recently extended the nationwide eviction moratorium that will help keep millions of people in their homes, even if they can't pay rent because of the pandemic. It's bringing both relief for those struggling to pay rent and plenty of concern from landlords who say they're missing out on money. Joining us now to talk about the impact of the eviction protection is Diane Yentl. She is the CEO of the National Low-Income Housing Coalition. And we're also joined by Yahoo Finance's Danny Romero. Great to have you both here. And Diane, I'm going to start with you. What are you hearing right now from members regarding the kind of help they're able to receive in terms of rental assistance?
Well, there's a lot of concern. The emergency rental assistance that Congress provided should be enough to cover all the rent and utility arrears that tenants accrued during the pandemic, but the money is getting out much too slowly. As of the end of June, only about $3 billion of $46.5 billion appropriated had been spent. The number is increasing. The month of July was better. Some programs are really ramping up and getting that money out quickly. Many others still lag behind. And meanwhile, while the eviction moratorium has been extended through early October, there are legal challenges to that moratorium. The U.S. Court of Appeals will likely rule any minute, any day. And then the next step will be the U.S. Supreme Court. And so the challenge is that we may not have until October 3rd for the moratorium to remain in place. So there's even more urgency to get that money out quickly. We hear every day, we get dozens of emails and calls here at the coalition from tenants who have applied for money, who are desperate to receive that money, who are scared they're going to lose their homes if they don't get it in time, but who haven't received that money yet.
And Diane, in a recent study by the Urban Institute, they found that more than half of renters and 40% of landlords are not even aware of this federal assistance. And I know that each state had to come up with their own program in the way that they were going to distribute these funds. Why is there a lag and lack of knowledge?
Yeah, that's one of the main challenges right now. The way that the emergency rental assistance programs work is the federal government allocates a certain amount to states and cities and counties, and then those states, cities, and counties are responsible for getting that money out. So we're tracking nearly 500 emergency rental assistance programs across the country. Again, some of them are doing really well. Some of them are getting the money out quickly and to the people who need it. And the fact that some are doing so well make those who aren't all the more glaring and unacceptable. And one of the reasons in some places that we're finding that the money is not getting out is simply that landlords and tenants are not aware that those resources are available, or they don't know what they need to do in order to receive them. So there needs to be much more public education at federal, state, and local levels about the availability of these funds. Another challenge is that some of the communities who have the funds and have created emergency rental assistance programs have made them much too complicated, very long and unnecessarily complicated applications requiring burdensome documentation that many of the lowest income people simply can't produce. So having such some complicated systems is also slowing down the process for everyone.
Yeah, and an eviction moratorium is, fine for the short term, but what are we really going to do to help these people in the long term? I mean, on both sides, a tenant and a landlord.
Right, the eviction moratorium, it's been essential. It's been a lifeline. It has kept tens of millions of people who otherwise would have lost their homes during a global pandemic stably housed during it. But it's always been a half measure because the rent is still due and low-income tenants struggled to pay it and fell behind during the pandemic. That's why the emergency rental assistance has been so essential for Congress to appropriate, and it's why states and cities need to do more and better and faster to get that money out to the tenants who need it as quickly as possible before the moratorium inevitably expires or ends. But that money, that emergency rental assistance, does little to nothing to address the underlying affordable housing crisis that we faced pre-pandemic and during the pandemic, and that will continue to face after the pandemic. Those same renters who struggled to pay the rent during the pandemic, even after they're caught up on rent, many of them will continue to struggle because housing costs too much for them to be able to afford. So long-term solutions are necessary. And the good news here is that Congress is currently negotiating a multi-trillion-dollar infrastructure and reconciliation package that could include over $300 billion in housing investments. So we have an opportunity now to ensure that those funds are allocated and that they are targeted toward the solutions that keep the lowest income people safely and accessibly and affordably housed. Those are the kind of long-term solutions that are needed.
Yeah, and also in your recent report, there was a pretty alarming graph that shows that 56% of renters have had to cut back on food expense. And I know that survey was done specifically in LA County. But as this goes on, will we see more of that?
We've seen that throughout the pandemic and even before the pandemic. The thing to understand about the crisis that we face now is that before the pandemic, we had a shortage of 7 million homes that were affordable and available to the lowest income renters. So another way of saying that same number is for every 10 of the lowest income renter families, there were fewer than 4 apartments affordable and available to them. And because there was such a shortage, we had about 10 million very low, extremely low income households paying at least half of their very limited incomes towards rent each month. In order to be able to do that, that means everyday trade-offs. That means having to forego store-bought food and having to rely on food pantries instead. It means not being able to pay the internet for the virtual school that their children need. It means borrowing money, using credit cards to pay the rent, all unsustainable solutions. And again, it's because the gap between what the lowest income people earn or otherwise bring in is great. And the gap is growing between what they earn and what rent costs. So solutions are needed to make homes affordable for those lowest income people. Solutions like permanent rental assistance for the lowest income households. Every eligible household should be able to receive longer term housing subsidies when needed. And building more apartments and ensuring that we're building them at a level that's affordable to those lowest income people with the greatest and the clearest needs.
All right, Diane Yentl, CEO of National Low Income Housing Coalition, and our own Danny Romero, thanks so much. This week, New York City became the first in the country to require people to show proof of vaccination against COVID-19 before dining indoors, visiting a gym, or going to an indoor entertainment venue. Anyone who works in those impacted businesses must also be vaccinated. This rule is going to go into effect and be enforced September 13th. Joining me now is Chef Vincent Cortese, the new executive chef at Bar Boulud, Michelin-starred chef Daniel Boulud's signature French bistro in the heart of New York City. And Chef, it is good to see you here on the show, and congratulations on being appointed executive chef of Bar Boulud. I know that you're in the kitchen, but I'm curious what the front of house is seeing in terms of folks coming in and needing to show proof of vaccination. What are you hearing from customers?
Well, this is new for us. We just started, but so far it's been much smoother than I expected personally. I think most of our clientele is proud to be vaccinated and happy to show proof of it. And we really haven't had too many hiccups so far. So fingers crossed that it stays that way.
Yeah, there are a few restaurants, so sort of a small contingent of restaurant owners who are actually suing Mayor Bill de Blasio in the city of New York for mandating this proof of vaccination. But your boss, Chef Daniel Boulud, is actually supporting the mayor in this. Was he going to do this regardless as to whether or not the city was going to mandate vaccines? Do you know?
Well, everything happened very quickly, but as soon as we got wind of the severity of the Delta variant and everything, we've always erred on the side of caution. And it's really important for us to keep not only our guests safe, but our staff safe. So, since the beginning, I've been here at Bar Boulud since September of last year. And we've always been very cautious and trying to keep the staff with the masks on all day, and the customers as well. And we've just been fully compliant with the city since the beginning. So, we'll continue to do so.
Talk to me a little bit about the labor shortage that especially the restaurant industry has been going throughout the pandemic. And for a lot of places, kitchen work is some of the hardest to find. What have you been seeing there at Bar Boulud?
Absolutely. It has been difficult. We have been slightly fortunate here at Bar Boulud in keeping a largely full staff in the kitchen and the front of the house. But it is very difficult for all restaurants, not only in New York City, but I think in the whole country, to find adequate staff. But basically, we just keep plugging away, and we've been fortunate to find people that I've worked with previously and that, other members of the staff have worked with. And, we try to create a healthy work environment here. So people, when they come in and they trail and interview, they feel comfortable and happy, and they see people are happy doing what they're doing at work. And we've been fortunate to keep a relatively full staff here. So very grateful for that.
Good for you guys. Now, I want to get to the good stuff, which is the menu. I know that it's a seasonal menu traditionally at Bar Boulud, a classic French, but you're going to be doing this with your own unique style, put your own twist on your dishes. Can you give us a taste of what we might expect from your kitchen, chef?
Yeah, absolutely. So currently our menu is structured in a way that it's basically half of the menu is Bar Boulud dishes and half is Boulud Sud dishes. To sort of offer a diverse menu to the clientele who's been coming here for a number of years and that miss Boulud Sud. So we have a lot of French bistro dishes on the menu for the Bar Boulud section, and then some more Mediterranean-inspired dishes for Boulud Sud. But we are targeting a September opening for Boulud Sud, which we're very excited about. So we'll start to phase out some of those Mediterranean Boulud Sud inspired dishes, and start to work on more classic French bistro dishes. For me personally, I think that for restaurants and for dishes specifically, it's important that they are at least somewhat rooted in some tradition, but it's really nice to have, a chef's personal touch on the dish as well. So that's usually how I go about creating menu items.
Yeah, sounds like a good way to do it. Excited to see what you come up with. Vincent Cortese, the new executive chef there at Bar Boulud. I look forward to stopping by when I'm back in the city soon. Best of luck to you and your team.